Welcome back to Market on Close. I'm Marley Caden here in our Chicago headquarters alongside Sam Vadas in New York. Let's turn our attention to crypto and welcome in our next guest. Joining us now, Phong Le, the president and CEO of Strategy. Phong, thank you for taking the time to be with us this afternoon. Now, Strategy just completed its largest single-time Bitcoin purchase since July. You added nearly $1 billion in just the past week. What drove the timing and the scale of this latest acquisition?
Yeah, look, Bitcoin is always an important purchase and a good buy for us at any point in time. 2 weeks ago, we announced that we were creating a U.S. dollar reserve to stabilize the ability to pay our dividend over the next 2 to 3 years. And on the back of that, we thought that the equity price was improving, or multiple to NAV was improving. So it was a good time for us to purchase Bitcoin. And we saw a lot of volume and liquidity in our stock last week. So we thought it was a good time to do it. And $1 billion is a nice amount of Bitcoin to buy.
Yeah, it certainly is. And you've outlined a strategy. You mentioned your dividend, where the U.S. dollar and Bitcoin reserves could cover your dividend obligations for decades. I think you said even into 2100. Is that even how we'd refer to that year? In a hypothetical scenario where we saw a prolonged Bitcoin winter, is there a case where Strategy would ever consider selling Bitcoin to meet dividend commitments, or is that a hard line?
Yeah, the math works like this. If we just use our U.S. dollar reserve, we'll be able to pay down our dividends till 2029, at which point we would have to look at Bitcoin derivatives or Bitcoin itself. If the Bitcoin price was to go down by 50%, we could use Bitcoin to pay our dividends through about 2065. If Bitcoin price was flat, we could use Bitcoin to pay our dividends through 2100. And if Bitcoin price went up 1.25%, we could pay our dividends into eternity. All that said, what's important is paying our dividends, more important than not selling Bitcoin. So if we get to the point we need to in 2029 and we have a prolonged 3-year Bitcoin winter and a 3-year downturn in our multiple to NAV, then we would sell Bitcoin to pay the dividends. And what's most important is paying those dividends gives us access to a $60 trillion credit universe, and that's what we're really focused on.
And many comment whenever we see Strategy making these large purchases that they are a bullish signal for the broader crypto market. Was that part of your intention with this latest purchase, or is the focus just solely on your balance sheet strategy here?
It's focused on our balance sheet strategy, and we purchase Bitcoin when we think it's accretive to our shareholders. We're not thinking week to week, are we doing something that's bullish or bearish for the Bitcoin market? For the last 5 years, I think what we've been doing is bullish for the Bitcoin market, and so we don't think about it week to week.
And I saw a recent interview with you where you said that Strategy now has what you called more flexibility than ever to accumulate Bitcoin, thanks to your long-dated debt and your equity financing structure. Can you remind our viewers exactly how that capital structure works, and if there was a condition in which you would consider pausing or reversing your Bitcoin accumulation?
Yeah, I'll start with, we're a pretty low leverage company, right? If you look at our convertible debt, we have a leverage of about 11%. If you include our preferreds in there, we have about a 25% leverage. Average S&P 500 company has 60% leverage, and a highly levered company would be 200 to 300%. So we have a lot of flexibility. By moving from convertible bonds to preferreds, we actually now have moved from mid duration, 3, 4, 5 year debt that we have to pay back to perpetual credit that we never have to pay back. And that's beneficial to us. What's beneficial to the $60 trillion credit industry is we're going from paying people 0%, 3.5% on the money market, 7% on private credit, to 10.75% in an instrument like Stretch that's paid monthly in cash, and it's tax deferred because of the return of capital treatment. It really just transforms and revolutionizes the credit market. So we now have the supply of credit, and we have the demand from the market. And I think it has an ability to really not just transform how credit is thought of, but also bridge the income gap that exists right now, because people who aren't able to get these returns can get it through our instruments. That's why we're excited about them.
And I want to pivot here to the MSCI and some of the proposed changes to the index criteria, particularly for digital asset companies. You recently submitted a letter to address some of the proposed changes. Can you walk us through some of what the concerns are for Strategy, and also what a successful outcome would look like?
Yeah, we submitted a letter this morning in response to MSCI's proposal to exclude companies that have greater than 50% of their assets in digital assets. And it's an interesting, curious proposal. I have a lot of respect for the indexes like MSCI, FTSE, S&P, and NASDAQ. But this one's quite misinformed and misguided, and I'll give you the reasons why. One, they characterize us and other digital asset companies as funds, not operating companies. I've been CFO since 2015. Michael Saylor founded the company in 1989. We've been public in 1998. I work here day to day, and we are 100% an operating company legally from a corporate structure and what we do day to day. Second, they set a 50% threshold, which feels very arbitrary. And if you think about how that would be executed, companies that might go to 55% down to 30%, it'd be very unworkable. Third, and this is probably what's most concerning, is indexes are supposed to be neutral. And here they're injecting what I would call policy considerations and opinions. And if they were to have done that, they might say that Chevron, which has 67% of their assets in oil, shouldn't be in an index. Newmont's a gold miner. They have 61.5% of their assets in gold. Weyerhaeuser's a timber company, 70% of their assets in wood. Simon Property Group owns malls. I'm looking at one of their malls right outside my window. 66% of their assets in real estate. So it's interesting why Bitcoin, why digital assets wouldn't look like those companies and why Strategy doesn't. And the last thing I'll say is we're very early in the industry. We entered as the first Bitcoin treasury company in 2020. We really saw that large increase in Bitcoin treasury companies in 2025 this year. And it seems very early to pick winners and choosers and stifle innovation in a category like this. I would say this is akin to saying that oil miners shouldn't have had their assets, or oil companies shouldn't have had their assets in oil rigs and oil in the early 20th century. This would be like in the 1980s saying that telecom companies shouldn't have built out cell towers and spectrum, or 3 years ago and saying AI companies shouldn't be investing in LLMs and high performance compute. It just seems early to make a decision that digital assets shouldn't be an area that people should invest in.
You bring up some good points there about the early innovators versus some of the longer standing companies here. A decision expected there by January for the MSCI. But as we look ahead to 2026, Fong, what do you see as the biggest opportunities for Strategy and also for the broader digital asset market?
I think what's going to happen is we're getting a significant amount of regulatory clarity in the U.S. I think the U.S. government has done a fantastic job passing the Genius Act and soon to be passed, hopefully, the Clarity Act. And that really just opens up the ability to truly innovate in digital assets. And I think what you're going to see, and the opportunity I'm most excited about, are traditional finance banks, JP Morgan, Morgan Stanley, Citibank, TD, et cetera, entering into this space full force, full-fledged, creating crypto and Bitcoin custody, Bitcoin exchange services, Bitcoin lending services, Bitcoin staking services. And I think we'll see a brand new industry start to blossom, which is why I think it's odd that an index would decide right now to stifle it and go against, frankly, what the U.S. government has supported. But I think 2026 is going to be the year where we see the intersection of DeFi and TradFi in a big way.
Fong, we appreciate you taking the time to be with us on Market on Close today and talk to us a little bit more about Strategy. That's Fong Li, the president and CEO of Strategy.